Hello everyone, I'm Lewis, Market Strategist for Fullerton Markets. So in today's video, I'll be teaching you guys how to create an investment plan. So let's get right into it. First, you need to know what is your goal or purpose in investing. So is it for investment income, for growth, or is it for wealth preservation? Right, so for investment income, it can come in the forms of dividends or interest, right? For example, a high yield savings account or dividends from stocks that you purchase over the stock exchange. And as for growth, it's usually stocks appreciation or the appreciation of a commodity, right? It can be watches, it can be gold bars, right? So it depends on what kind of commodities that you are holding and you are hoping for appreciation in capital. And lastly, wealth preservation. Usually what people do is, they put money into a trust when it gets big enough, or they can also put money into safe bonds. So for example, government bonds. These instruments are usually safer, right? And usually the government will guarantee the amount that you put into the government bonds as well. Next, we need to know how much are you willing to invest realistically. Alright, so of course, we don't want you to borrow money or put in too much money into investments without having sufficient buffer for any possible rainy day or accidents. Right? So when you put money into investments, you should be able to treat the money as already gone, right? You have to remove the emotional attachment to that sum of money. And the next question will be, how much should I put in? Because it all depends on the returns that you're looking at. So first, we have to find what kind of returns you're looking at, the instruments, and then from there, you can work backwards, right? To adjust it to the goals that we have set in the first point, right? So whether is it for dividends, for capital appreciation, or even wealth preservation. So of course, in the case of wealth preservation, you must remember that for retirement purposes, we have to always go for the lowest risk and yet highest liquidity instrument. The reason why is because when you are moving into retirement, usually you don't have much time for the specific investments to compound, right? So usually you put your money into something safer and liquid so that you can always withdraw it anytime without penalty. And the third point will be, how much risk are you willing to take? Right? So it's very different on how much are you willing to invest, because at this point of time, we'll be looking at the risk component. So for traders, there's three categories of risk, right? Simply low risk, medium risk, or high risk. And risk comes in the form of returns as well, right? So if you are looking for a low risk investments, the returns most of the time will be low risk as well. And of course, as per medium risk will be medium return, and high risk is where you will get your highest return. So you need to know what is the risk profile of yourself, or some people say what is the risk tolerance of yourself. It's only then that you can make a sound decision on whether you are going to invest into a low risk, medium risk, or high risk product, because it all depends on your risk tolerance. And risk tolerance comes in the form of your age, right, your commitment, the expenses that you need, and then we will be able to find out how much risk are you able to take. And lastly, once you have the answers to the first 3 points, the last question will be, what instruments should you invest in? And that will come easily because you already know how much money are you able to put in, what is your purpose, how much risk are you able to take. With these three combined, you will be able to find the instrument that will fit you the best. But of course, from here on, the instrument, we can categorize it into two parts as well, right? So first will be active investing, second will be passive investing, right? So knowing this, you must see, whether you have the time to go into active investing. So for example, trading in Forex, stocks, CFDs, even crypto nowadays, right? And as for passive, usually is for rental yield. People buy stocks for dividends. They buy financial products for dividends as well, right? So all this will depend on your time and how much commitment can you put into your investments, right? So now that you have an idea or a structure on how to create your own investment plan, make sure that you stick to it. Alright, so that's the end of today's video. I will see you guys in the next video. Bye bye.